What is a stock screener? A stock screener is a tool that allows investors and traders to filter stocks based on specific criteria. These criteria can include various financial metrics, technical indicators, market capitalization, sector, and more. By using a stock screener, users can quickly identify stocks that meet their investment strategies or trading criteria. The uses of stock screeners, that's the heading. Identifying potential investments. Investors use screeners to find stocks that match their investment strategies, such as value investing, growth investing, or dividend investing. Next, market analysis. Traders use screeners to analyze market trends and identify opportunities for short-term trades. Third, risk management. Screeners help in identifying stocks that meet specific risk parameters, helping investors to manage their portfolio risk effectively. 4. Sector analysis. Investors can use screeners to focus on specific sectors or industries that are expected to perform well. 5. Technical analysis. Traders use the screeners to find stocks that meet technical criteria such as moving average, RSI level, or a chart pattern. How to code a stock screener? First step, setting up the environment. You will need a programming environment and some libraries to start coding a stock screener. Python is a popular choice of language due to its extensive libraries and ease of use. Required libraries in Python are pandas for data manipulation, yfinance or alpha underscore vantage for retrieving stock data, numpy for numerical operations, and matplotlib for plotting if needed for analysis. Installation. Code is pip install pandas yfinance numpy matplotlib. Step 2, importing of libraries. Under Python, import pandas as pd, import yfinance as yf, import numpy as np, import matplotlib.pyplot as plt. Step 3, define screening criteria. Decide on the criteria for your stock screener. For example, you might screen for stocks with a market capitalization of over 10 billion or a PE ratio of under 20. Step 4, fetch stock data. Use the yfinance library to fetch stock data. Here is an example of how to get data for a list of stocks. 1. Hash. Define the stock symbols you are interested in. Stocks is equal to, within big bracket, AAPL, MSET, Google, Amazon, Tesla, and fetch data from yfinance. Hash fetch data from yfinance. Stock underscore data is equal to yf.download within brackets stocks comma period is equal to 1 year. 1y. Step 5, applying screening criteria. Filter the stocks based on your criteria. Here is an example, filtering based on market capitalization and PE ratio. Hash. Fetch additional information like market cap and PE ratio. Stock underscore info is equal to flower bracket symbol colon yf.ticker bracket symbol dot info for symbol in stocks. Hash. Convert to data frame. Stock underscore info underscore df is equal to pd dot data frame within brackets stock underscore info dot I. Hash. Define screening criteria. Market underscore cap underscore min is equal to 1910E9. Hash 10 billion rupees. PE ratio max is 20. Then apply criteria. Screen underscore stocks is equal to stock underscore info underscore df big bracket stock underscore info underscore df market cap big bracket close greater than market cap underscore min and stock info df within big brackets trailing PE less than PE ratio max. Print screened stocks. Step 6. Visualize or output the results. You might want to visualize the filtered stocks or simply output them. Here is an example of how to plot the closed price of screened stocks. Plot closing prices of screened stocks. For stock in screened stocks.index, data is equal to yf.download within bracket stock comma period is equal to 1y within quotes bracket close data big bracket within quotes close big bracket close dot plot within brackets label is equal to stock label close bracket close plt dot legend bracket open close plt dot title bracket open within quotes closing price of screened stocks within quotes bracket close plt dot x label within brackets data date plt dot y label within brackets within quotes closing price plt dot show opening bracket closing bracket. Summary: creating a stock screener involves defining your criteria, fetching stock data and filtering the stocks. Based on those criteria, Python with its rich set of libraries like pandas and yfinance makes it straightforward to build a customized stock screener to meet your specific needs. By automating the process, you can save time and focus on analyzing the most promising investment opportunities. Next, the use and significance of this code. Code step by step and then common one. Setting up the environment. First, we need to install the required libraries. So pip install pandas, yfinance, numpy, matplotlib. Significance: these libraries provide the necessary tools for data manipulation, that is pandas, fetching stock data, that is yfinance, performing numerical operations, that is numpy, and visualizing data, that is matplotlib. Next, step 2, importing libraries. Import pandas, yfinance, numpy and matplotlib. Significance: importing these libraries is crucial for utilizing their functions throughout the script. Each library serves a specific purpose. Pandas is for handling and manipulating data in data frame. yfinance is for accessing Yahoo Finance API to fetch stock data. Numpy for numerical operations. Matplotlib for plotting and visualizing data. Step 3, defining screening criteria. Decide on the criteria for your stock screener. It is screening for stocks with a market capitalization of over 10 billion and a PE ratio under 20. Then hash. Define the stack symbol you are interested in. Stocks is equal to, in quotes, AAPL, MSFT, Google, Amazon, Tesla. Significance: this list of stock symbols represent the initial set of stocks to be screened. These symbols can be customized based on user preference or broader market indices. Step 4, fetch stock data. Use the yfinance library to fetch stock data. Fetch define data from yfinance. Stock underscore data is equal to yf.download within quotes stocks comma period is equal to 1y within quotes bracket close. Significance: fetching historical stock data for the defined period within quotes 1 year in this case is essential for analyzing the stock performance over time and applying technical indicators if needed. Step 5, applying screening criteria. Fetch additional information and filter the stocks based on the defined criteria. Now the code is hash fetch additional information like market cap and PE ratio. Stock underscore info is equal to within flower bracket symbol colon yf dot ticker bracket symbol within brackets dot info for symbol in stocks. Hash convert to data frame. Stock underscore info underscore df is equal to pd dot data frame within brackets stock underscore info dot I. Hash define screening criteria. Market underscore cap underscore min is equal to 10E9 hash 10 billion. PE ratio max is equal to 20. Apply criteria. Screened stocks is equal to stock info DFF, stock info DF market cap min and stock info DF trailing PE less than PE ratio max. Print. Significance: fetching additional stock information provides necessary financial metrics like market capitalization and PE ratio. Converting this data into a data frame makes it easier to manipulate and analyze. Defining the screening criteria like market cap min and PE ratio max allows users to filter stocks that meet their specific investment criteria. Applying these criteria filters out stocks that do not meet the desired conditions, thereby narrowing down the list of potential investment candidates. Step 6. Visualize or output the results. Visualize the filtered stocks by plotting their closing prices. Plot closing prices for screened stocks. For stock in screened underscore stocks dot index hash data is equal to yf dot download within quotes stock comma period is equal to 1y within quotes, and then bracket close data big bracket within quotes close big bracket close dot plot within brackets label is equal to stock plt dot legend bracket open close plt dot title within brackets closing prices of screened stocks plt dot x label within brackets date plt dot y label within brackets closing price plt dot show. This gives you the graph on xy significance. Plotting the closing prices of the screened stocks provides a visual representation of their performance over the specified period. The visualization helps in quickly assessing trends and patterns in stock prices, aiding in further analysis and decision making. Summary. This code demonstrates the creation of a basic stock screener in Python, showcasing its utility and significance. Efficiency. Automates the process of filtering stocks based on specified criteria, saving time and effort. Customization allows users to define and adjust screening criteria based on their investment or trading strategies. Visualization provides visual insights into performance of screened stocks, aiding in better decision making. Scalability. The code can be expanded with additional criteria, more complex filters, and advanced analytics. Your stock advisor. Today we will try to understand how to create a useful screen. We will observe that you will need a platform for making your screens. The best platform we have in India is screener.in. This is the first pack. We may call it VVS pack 1. Now how do you make a screener? What is a screener? Screener is an effort which reduce the size of companies or a number of companies. Adding a criteria that screens for stocks based on their profit growth over the past 5 years compared to their sales growth over the same period can provide valuable insight into a company's operational efficiency and profitability. Adding the profit growth versus sales growth criteria. Step 1. Fetching additional data. First, you need to fetch the data required to calculate the profit growth and sales growth over the past 5 years. This can typically be done using financial statements data from API like Y-Finance, but note that Y-Finance might not always provide detailed historical growth rates directly. For simplicity, let's assume we have access to this data. Step 2. Define and calculate growth rates. You need to calculate the compound annual growth rate CAGR for both profit, net income and sales revenue over the past 5 years. Step 3. Apply the new criteria. Screen for stocks where 5-year profit growth is greater than 5-year sales growth. Example of the code here, you can integrate import Panda as PD, import Y-Finance as YF, import NumP as NP, hash define the stock symbols you are interested in. Stocks is equal to within big brackets AAPL, MSFT, Google, Amazon, Tesla. Hash function to calculate CAGR, define calculate underscore CAGR, end value, start value, periods, Return end value by start value star star within quotes 1 by periods is equal minus 0.0. Hash fetch financial data and calculate 5-year growth rates. Financial data is equal to lower bracket open and close for stock in stocks. Ticker is equal to yf dot ticker within quotes. Stock financials is equal to ticker dot financials. Use and significance of the criteria. Profit growth is more than sales growth. Use efficiency indicator. The criteria helps identify companies that are not only growing their sales but are also becoming more efficient in converting their sales into profits. It indicates that the company's operational efficiencies or cost management strategies are improving. Next, profitability focus. Investors looking for companies that are not just expanding their top line revenue but are also improving their bottom line, that is profit, will find this criteria valuable. Long-term health. Companies that can grow profit faster than sales over a sustained period typically have better control over cash costs, improved margins, and possibly a competitive advantage. Significance. Operational efficiency. A company with profit growth outpacing sales growth is likely managing its operations more efficiently, which is a positive sign for investors focusing on operational health. Investment quality. This criteria can help investors filter out companies that might be growing revenues but are not able to translate growth into higher profit, which could indicate issues with cost control or declining margin. Economic moat. Such companies might have a stronger economic moat, meaning they can maintain competitive advantage that allow them to increase profitability over time. Risk management. By focusing on companies with improving profitability relative to sales, investors can potentially reduce the risk of investing in companies that might be expanding sales at the expense of profitability. Summary. Incorporating the criterion of 5-year profit growth being greater than 5-year sales growth into a stock screener adds a layer of financial analysis that emphasizes operational efficiency and profitability. This helps in identifying companies that are not just growing but are also becoming more profitable over time, making them attractive for long-term investment. By using this criteria, investors can better ensure that their investments are in companies that have sound financial management and sustainable growth trajectories. Adding a criteria that screens for stocks based on their sales growth over the past 5 years being greater than 3% annually can help investors focus on companies demonstrating consistent top-line expansion. This criteria selects companies that have achieved an annual compounded sales growth CAGR of more than 3% over the past 5 years. Use and significance. Identifying growth companies. The criteria helps investors identify companies that are expanding their market presence and increasing their revenue consistently. Revenue assurance ensures that the company is not stagnant and is actively growing its revenue base, which is often a precursor to future profit growth. Sector analysis useful for focusing on sectors or industries that are generally growing, allowing investors to capitalize on sectoral trends. Long-term investment helps in finding companies suitable for long-term investment strategies that prioritize steady growth. Significance. Growth indicator. Sales growth is a fundamental indicator of a company's ability to increase its market share, launch new products, or expand its new markets. A 5-year CAGR greater than 3% indicates the company is consistently growing its revenue base. Market competitiveness. Companies achieving this level of growth are likely to be competitive in their respective markets, suggesting effective business strategies and strong demand for their product or services. Investor confidence. Consistent sales growth can build investor confidence in the company's future prospects, making it a more attractive investment option. Financial health. While profitability is crucial, revenue growth is often a leading indicator of financial health. Consistent sales growth can lead to higher profit and improved cash flow over time. Risk mitigation. Screening for companies with stable and positive revenue growth helps in mitigating the risk of investing in companies with declining or volatile revenue streams. Integrating a 5-year sales growth criteria of greater than 3% into a stock screener has several benefits. Focus on growth ensures that the screened companies are actively growing their revenues, indicating business expansion and market demand. Enhanced investment quality helps in identifying companies with sustained revenue growth, which is a positive signal for future performance. Risk reduction reduces the likelihood of investing in stagnant or declining companies, thus improving the overall quality of the investment portfolio. Long-term viability highlights companies with potential for long-term success, making them suitable for growth-focused investors. By using this criteria, investors can filter out companies that do not meet the minimum growth expectation, thereby refining their investment choices to include only those with a strong revenue growth trajectory. The return on equity more than 15% is a significant metric in stock screening and investment analysis. Understanding return on equity. Definition. Return on equity measures a company's profitability in relation to shareholders' equity. It is calculated as ROE is equal to net income divided by shareholders' equity. Significance of ROE more than 15%. Use. Profitability indicator. ROE indicates how efficiently a company is using its equity base to generate profits. A high ROE suggests that the company is effectively utilizing its resources. Comparative analysis. Investors use ROE to compare the profitability of companies within the same industry, as ROE greater than 15% is generally considered strong and can indicate superior management and operational efficiency. Investment quality. Companies with high ROE are often seen as high quality investments, as they can generate significant profits from shareholders' equity, shareholder value. A higher ROE indicates better returns to shareholders, which is a crucial aspect for investors looking to maximize their investment. Significance. Efficiency and management quality. An ROE greater than 15% typically signifies that the company's management is skilled in deploying capital efficiently to generate profits. It reflects positively on management's ability to make good investment and operational decisions. Financial health. A high ROE can indicate a financially healthy company with a strong ability to generate profits. It is often a sign of competitive advantage, such as strong brand recognition, cost leadership, or technological superiority. Growth potential. Companies with a high ROE are often capable of reinvesting their earnings at a high rate of return, potentially leading to sustained growth over long term. Investor confidence. Consistently high ROE can boost investor confidence, as it suggests that the company is capable of delivering strong returns on equity over time, making it an attractive investment. Risk management. Screening for high ROE helps in identifying companies that are likely to be less risky investment, as they have proven their ability to generate substantial returns from their equity. Implementing ROE more than 15% offers several benefits. 1. High profitability. Identifies companies that are generating strong profits relative to their equity. Efficient use of capital. Ensures that the company is effectively using its shareholders' capital to produce earnings. Quality investment. Highlights the companies that are generally considered to be high quality investment with potentially low risk. Sustained growth. Companies with high ROE are often capable of sustaining growth through effective reinvestment of earnings. By focusing on companies with ROE greater than 15%, investors can screen for businesses that are likely to offer strong financial performance, efficient management, and potential for long-term growth. This criteria helps in building a portfolio of high-quality, profitable companies, thereby enhancing overall investment returns. Working capital 5 years back less than zero focuses on the financial condition of a company from a historical perspective. Let's explore the significance. Understanding working capital. Working capital is a measure of company's short-term financial health and operational efficiency. It is calculated as working capital is equal to CA minus CL. Negative working capital. When working capital is negative, it means company's current liabilities exceed its current assets. This indicates potential liquidity issues, but in certain contexts it might not necessarily be negative. Working capital 5 years back is less than zero. Use. Historical financial health analysis. Evaluating a company's working capital from 5 years ago can provide insight into its historical financial health and operational challenges. Turnaround stories. Identifying companies that had negative working capital in the past but have improved their financial position can help in spotting turnaround stories or companies that have significantly improved their operations. Risk assessment. Understanding past liquidity issues can help investors assess the risk management strategies a company might have implemented to overcome financial distress. Significance. Liquidity management. A company with negative working capital 5 years ago might have faced liquidity issues, which is crucial for understanding its past financial difficulties and strategies it used to address them. Operational efficiency. In some industries, particularly retail, negative working capital can be a sign of operational efficiency, as companies can generate cash quickly from sales while deferring payment to suppliers. Debt management. This criteria can indicate how a company has managed its debt and short-term obligations over time, providing insight into financial discipline and stability. Growth potential. Companies that have turned around from negative working capital situations might have stronger management and better growth potential due to improved financial practices. Risk indicator. Persistent negative working capital can be a risk indicator suggesting potential cash flow problems. Evaluating this criteria helps in assessing whether the company has managed to mitigate such risks over time. Implementing working capital 5 years back less than zero offers several insights. 1. Historical liquidity insight provides a view of the company's historical liquidity and short-term financial health. Turnaround potential identifies companies that might have successfully turned around from past financial difficulties. Operational context. In certain industries, negative working capital might not be a red flag but a sign of efficient operations. Risk management helps in assessing how companies have managed financial risk over time and improved their working capital. By focusing on this criteria, investors can better understand the historical financial challenges a company faced and how well it has managed to improve its financial health. Commonly used financial metric to stock screening and investment analysis. Understanding debt to equity ratio. The debt to equity ratio is a measure of company's financial leverage. It's calculated as debt to equity ratio is equal to total liability divided by shareholder equity. A ratio of less than 1 indicates the company has less debt than equity. Significance of the criteria. Use. Leverage assessment. Correct. This criteria helps in assessing a company's leverage. A lower ratio indicates that the company is not excessively reliant on debt to finance its operations. Risk management. Companies with lower debt levels are generally considered to be at lower financial risk. This criteria helps in identifying such companies. Financial stability. A low debt to equity ratio is often associated with financial stability and conservative financial management, which can be appealing to risk-averse investors. Significance. Reduced financial risk. A debt to equity ratio of less than 1 suggests the company has more equity financing than debt, reducing its risk of insolvency and financial distress during economic downturn. This makes the company less vulnerable to interest rate increases and financial market volatility. Cost of capital. Companies with lower debt levels tend to have a lower interest expenses, which can improve profitability and free up cash flows from other uses, such as investment in growth opportunity or returning capital to shareholders. Creditworthiness. A low debt to equity ratio can enhance a company's creditworthiness, making it easier and cheaper to access additional financing if needed. This can be crucial for growth and expansion initiatives. Investor confidence. Investors often view companies with lower debt levels as safer investment. This can lead to higher investor confidence and potentially higher valuations. Operational flexibility. Companies with less debt have greater operational flexibility. They are less constrained by debt covenants and have more freedom to pursue strategic initiatives, such as acquisitions without worrying about debt repayment. Long-term sustainability. Lower leverage is generally indicative of a long-term sustainability. Companies that avoid excessive debt are more likely to survive and thrive over long term, even in adverse market conditions. The debt to equity less than 1 is significant. 1. For reduced financial risk, identifies companies with lower financial leverage, which are generally at a lower risk of insolvency. Improved profitability. Companies with less debt have lower interest expense, enhancing their profitability. Enhanced creditworthiness. Companies with lower debt level are more likely to obtain financing at favorable terms. Investor confidence. Stock with lower debt to equity ratio are often viewed as safer investment, attracting more conservative investors. Operational flexibility. Less debt means more flexibility in strategic decision making and operations. By focusing on companies with a debt to equity ratio of less than 1, investors can identify financially stable and less risky investment opportunities, leading to potentially more stable returns and lower investment risk. Focuses on the financial structure and strengthens strength of a company. The significance is understanding the term reserves. Reserves are a part of shareholders' equity and represent retained earnings and other surplus funds set aside by a company from its profits over the years for future use. This can include retained earnings, general reserve, and other comprehensive income. Equity capital. Equity capital, also known as share capital, is the initial amount of money invested by shareholders when a company is first started or through additional share offerings. It represents the nominal value of company shares issued to shareholders. Significance. Use. Financial health indicator. This criteria helps in assessing the financial health and sustainability of a company. Higher reserves relative to equity capital indicate the company has successfully retained and reinvested its earnings over time. Operational stability. Companies with high reserves relative to equity capital are typically more stable and capable of withstanding economic downturn as they have accumulated significant internal funds. Investment quality. This criteria can identify companies that are not only reliant on external financing, making them potentially better investments. Significance. Earnings retention and reinvestment. A company with reserves greater than its equity capital indicates it has consistently generated profit and retained a substantial portion of these earnings rather than distributing them all as a dividend. This suggests strong profitability and prudent financial management. Buffer against losses. Higher reserves act as a financial buffer, allowing company to absorb losses during difficult period without jeopardizing its operations. This enhances the company's financial resilience and reduces the risk of insolvency. Operational flexibility. Companies with large reserves have more flexibility to invest in growth opportunities such as new project acquisition, research and development without needing to raise additional capital. This can lead to sustainable long-term growth. Attractive to investors. High reserves compared to equity capital can make a company more attractive to investors as it signifies financial prudence, stability and potential for future growth. Debt reduction. Significant reserves can be used to reduce debt, thereby improving the company's debt-equity ratio and overall financial health. This can lower interest expenses and improve profitability. Dividend potential. Companies with large reserves may have greater potential to pay dividend in future, providing returns to shareholders while still retaining their funds for growth. Now, it offers several benefits. Financial stability. Identifies companies with strong financial reserves, indicating prudent earnings retention and robust financial health. Operational flexibility. Highlights companies that have flexibility to invest in growth opportunities without needing additional capital or raising additional capital. Risk mitigation. Provides a measure of the company's ability to withstand economic downturn and absorb potential loss. Investment attractiveness. Focuses on companies that are potentially attractive to investors due to their strong financial management and stability. Its implications are year-on-year quarterly profit growth. The term. This measures the percentage increase in company's profit for a specific quarter compared to the same quarter in the previous year. Year-on-year quarterly sales growth. This measures the percentage increase in a company's sales revenue for a specific quarter compared to the same quarter in the previous year. Significance. YOY quarterly profit growth greater than YOY quarterly sales growth. Use. One efficiency indicator. This criteria helps in assessing the operational efficiency and profitability of a company. If profit growth exceeds sales growth, it indicates that the company is improving its profit margin. Cost management. It suggests effective cost management and expense control, implying that the company is able to convert a higher portion of its sales into profits. Quality of growth. This criteria distinguishes companies that are not just growing their top line revenue but are also enhancing their bottom line profit, indicating sustainable and quality growth. Significance. Improved profit margins. When profit growth outpaces sales growth, it typically means the company is increasing its profit margins. This could be due to cost reduction, increased pricing power, or operational efficiency. It reflects the company's ability to manage operational cost effectively. This can include better procurement practice, streamlined operations, or leveraging economies of scale. Sustainable growth. Companies that grow profits faster than sales are often better positioned to long-term sustainability. This is because they are not just expanding their revenue base but are also becoming more efficient and profitable. Investor confidence. Investors often view such companies favorably as they indicate strong management performance and the ability to deliver higher returns on investment. Competitive advantage. Consistent higher profit growth relative to sales growth can indicate competitive advantage such as unique product, strong brand or superior technology, which allows the company to command higher prices or lower costs. Financial health. This criteria can be a sign of strong financial health and management's ability to create shareholder value through effective strategies that enhance profitability. YOY quarterly profit growth greater than YOY quarterly sales growth offers several benefits. 1. Operational efficiency. Highlights companies that are improving their efficiency and profitability. Cost management. Indicates effective management of cost and expenses leading to better profit margin. quality growth. Focus on companies that are not only grow their revenue but also enhance their profitability, suggesting sustainable growth. Investor confidence identifies companies likely to inspire confidence among investors due to their ability to generate higher profit from increased sales. Competitive advantage suggests that the companies may have a competitive advantage allowing for better profitability. By using this criteria, investors can identify companies that are not only growing but are also becoming more profitable, which can be a sign of strong management and a potentially lucrative investment. The combined criteria of stock selection are profit growth 5 years more than sales growth 5 years, and sales growth 5 years more than 3, and return on equity more than 15, and working capital 5 year back less than 0, and debt to equity less than 1, and reserves greater than equity capital, and YOY quarterly profit growth and YOY more than YOY quarterly sales growth. Now put to CHAT GPT. It says combined criteria analysis. Profit growth 5 years more than sales growth 5 years. Significance. Indicate company is not only growing its revenue but also improving its profitability at a faster rate. This suggests efficient cost management and ability to scale profitably. Impact. Companies meeting this criteria are likely to be more efficient and have stronger earning growth, making them attractive for long-term investment. Next, sales growth 5 years more than 3%. Significance. Ensures that the company has a healthy revenue growth rate, which is a fundamental indicator of business expansion and market demand. Impact. Consistent revenue growth is crucial for sustaining operations and funding future growth opportunities. It indicates a growing market presence and customer base. Third, return on equity more than 15%. Significance. Reflects the company's ability to generate substantial profits from shareholders' equity, indicating efficient use of equity capital. Impact. High ROE companies are generally considered high quality investment due to their ability to deliver strong return to shareholders. Working capital 5 years back less than 0. Significance. Historically, negative working capital can indicate a company's efficiency in managing its short-term liabilities and operating cycle, especially in industries like retail where quick inventory turnover is common. Impact. Suggests that the company has previously managed operations efficiently, which can be a positive sign for operational management. Debt to equity less than 1. Significance. Indicates that the company has more equity than debt, reflecting a conservative approach to leverage and lower financial risk. Impact. Companies with lower debt levels are generally more financially stable and less exposed to interest rate fluctuations and economic downturns. Reserves is greater than equity capital. Significance. High reserves compared to equity capital indicate that the company has retained substantial earnings over time, providing a buffer for future uncertainties and funding for growth. Impact. Ensures that the company has strong internal resources and financial flexibility, reducing the need for external financing. Next, YOY quarterly profit growth greater than YOY quarterly sales growth. Significance. Suggests that the company is improving its profit margins and becoming more efficient in converting sales into profit. Impact. Indicates strong operational efficiency and effective cost management, which can lead to sustainable long-term profitability. Combined impact of the criteria. By applying these combined criteria, investors can identify companies that exhibit 1. Strong growth and profitability. Companies with higher profit growth than sales growth and consistent sales growth over 5 years are likely to be expanding efficiently and effectively. High returns. A high ROE indicates the company is generating strong returns on equity, making it an attractive investment. Operational efficiency. Historical negative working capital and better profit growth than sales growth indicate efficient management of operations and resources. Financial stability. Low debt levels and high reserves relative to equity capital reflect a strong balance sheet and financial health, reducing investment risk. Resilience and flexibility. Companies that meet these criteria are likely to be resilient in economic downturns and flexible in seizing growth opportunities. The combination of these criteria then will result in companies 1. Efficient in operations and resource management, financially stable with strong balance sheet, growing their revenue and profits consistently, offering high returns to shareholders, capable of sustaining growth and managing financial risks effectively. Using these combined criteria, investors can build a portfolio of companies that not only show strong current performance but also have the potential for sustainable growth and profitability in future. This holistic approach ensures a comprehensive assessment of a company's financial health, operational efficiency, and long-term viability. company's financial health and growth potential, profitability, and operational efficiency, which is excellent for comprehensive stock selection. However, there are always room for refinement or adjustment based on specific investment goals, risk tolerance, and market conditions. Here are some potential changes or improvements. Number 1. Adjusting growth threshold. The threshold for profit and sales growth, both for 5 years and year on year, can be adjusted based on industry norms, company size, and growth expectations. This ensures that the criteria remain relevant and realistic. Second, incorporating industry comparisons. Comparing a company's performance metrics to industry benchmarks can provide better context and help identify outliers. Adding criteria for industry relative performance might enhance the screening process. Third, including cash flow metrics. While profitability metrics are essential, incorporating cash flow metrics such as free cash flow yield or operating cash flow can provide additional insight into company's financial health and ability to generate cash. Considering valuation measures. Adding value metrics like price to earning ratio, price to sales ratio, or enterprise value to EBITDA ratio can help assess whether a stock is attractively priced relative to earnings or cash flow. Evaluating debt maturity and structure. Instead of solely focusing on debt to equity, considering factors like debt maturity, interest coverage ratio, and debt covenants can provide a more nuanced understanding of a company's debt profile and financial risk. Qualitative factors. While financial metrics are crucial, considering qualitative factors such as management quality, competitive advantage, market positioning, and industry dynamics can complement quantitative analysis and provide a more holistic view of a company's investment potential. That means in addition to the above quantitative analysis based on numbers, we have to comment on 1. Management quality, 2nd. Competitive advantage, 3rd. Market positioning, and 4th. Industry dynamics. Next, dynamic criteria. Considering incorporating criteria that dynamically adjust based on market conditions or macroeconomic factors. Example, during economic downturn, criteria related to financial stability and liquidity will carry more weight. Backtesting and validation. Before finalizing the criteria, it is essential to backtest them using historical data to ensure they effectively identify high quality stocks and align with investment objectives. Regular validation and refinement based on performance feedback can improve the effectiveness of the screening process over time. By iteratively refining and customizing the criteria based on specific investment objectives and market conditions, investors can develop a robust screening framework tailored to their preferences and goals. Additionally, consulting with financial advisors or conducting thorough research on industry best practices can provide valuable insight for optimizing the criteria. 5 years more than sales growth 5 years, and sales growth 5 years is more than 3, return on equity more than 15, working capital 5 year back less than 0, net equity less than 1, reserves greater than equity capital, year on year quarterly profit growth is greater than year on year quarterly sales growth. Okay. Now, we'll add a few more as suggested by CHAT GPT, like free cash flow more than 40, enterprise value to EBITDA, EV by EBITDA more than 10, interest coverage ratio more than 3. The combined criteria for stock selection will yield in the following impact. Profit growth 5 years more than sales growth 5 years. Criteria ensures company is not just increasing its revenue but also improving profitability over a significant period, indicating efficient cost management and scalability. Sales growth 5 years more than 3%, requiring minimum sales growth rate over a 5 year ensures that the company is expanding its top line at a healthy pace, which is crucial for sustaining operations and driving long-term growth. Return on equity more than 15%. High ROE indicates the company is generating substantial returns for shareholders relative to its equity, suggesting effective capital utilization and operational efficiency. Working capital 5 year back less than 0. Historical negative working capital can indicate efficient management of short-term liabilities and operational efficiency, providing insight into the company's financial management practices. Debt to equity less than 1. A low debt to equity ratio indicates the company has a conservative capital structure with more equity financing than debt, reducing financial risk and ensuring greater stability. Reserves greater than equity capital. Companies with reserves exceeding equity capital have accumulated retained earnings and surplus funds, providing a financial cushion for future investments and demonstrating prudent financial management. Next, YOY quarterly profit growth greater than YOY quarterly sales growth. This criteria highlights companies that are improving profit margins and operational efficiency, which are indicative of sustainable growth and effective cost management. Next, free cash flow yield greater than 40%. Requiring a high free cash flow yield indicates the company generates significant cash flow relative to its market capitalization, which can be used for reinvestment, debt reduction, or distribution to shareholders. Enterprise value to EBITDA, EV by EBITDA ratio more than 10. High EV by EBITDA ratio suggests that the company's enterprise value is relatively high compared to its EBITDA, which may indicate growth potential or market expectations. Interest coverage ratio more than 3, ensuring that the company's earnings before interest and taxes EBIT can cover its interest expenses at least 3 times, indicates a healthy ability to meet debt obligations from operating income. Combined impact. Financial strength and efficiency. This combined criteria evaluate various aspects of financial performance, ensuring that selected companies demonstrate strong profitability and efficient operations and robust financial health. Growth potential. By emphasizing consistent growth in both sales and profits, along with indicators of operational efficiency and prudent financial management, the criteria identify companies poised for sustainable growth and value creation. Risk management. Requirements such as low debt levels, positive working capital history, adequate interest coverage mitigate financial risk and enhance the company's resilience to economic challenges. Cash flow and value creation. The inclusion of free cash flow yield and EV by EBITDA ratio criteria ensure that the selected companies generate significant cash flow and create value for shareholders respectively. Considerations for improvement. While combined criteria provide solid foundation for stock selection, continuous refinement and adaptation essential. Consider dynamic adjustments. Regularly review and adjust criteria thresholds based on changing market conditions, industry dynamics, and company-specific factors. Next, incorporate qualitative factors. Supplement quantitative analysis with qualitative factors like management quality, competitive positioning, and industry outlook for a more comprehensive assessment. Scenario analysis. Conduct scenario analysis to evaluate how changes in key variables, interest rates, industry trends may impact selected companies' performance and resilience. By iteratively refining and adapting the criteria, investors can construct a robust framework for identifying high-quality investment opportunities aligned with their investment goals and risk tolerance. Additionally, consulting with financial professionals or conducting peer comparisons can provide valuable insight for further optimizing the selection criteria. This is the analysis of the CHAT GPT refined stock screener, VVS PACK. नामानि प्रातृप्ताय पटे शनेश्वरकृता पीडानि कदाचित् भविष्यति कोणस्थपिङ्गळवृक्ष्णो रुद्रान्तको यमः सौरिशनेश्वरो मनपि प्रलादेन संस्था एतानि दशनामानि प्रातृप्ताय पटे शनेश्वरकृता पीडानि कदाचित् भविष्यति कोणस्थपिङ्गळवृक्ष्णो रुद्रान्तको यमः सौरिशनेश्वरो मनपि प्रलादेन संस्था एतानि दशनामानि प्रातृप्ताय पटे शनेश्वरकृता पीडानि कदाचित् भविष्यति कोणस्थपिङ्गळवृक्ष्णो रुद्रान्तको यमः सौरिशनेश्वरो मनपि प्रलादेन संस्था एतानि दशनामानि प्रातृप्ताय पटे शनेश्वरकृता पीडानि कदाचित् भविष्यति कोणस्थपिङ्गळवृक्ष्णो रुद्रान्तको यमः सौरिशनेश्वरो मनः प्रलादेन संस्था एतानि दशनामानि प्रातृप्ताय पटे शनेश्वरकृता पीडानि कदाचित् भविष्यति कोणस्थपिङ्गळवृक्ष्णो रुद्रान्तको यमः सौरिशनेश्वरो मनः प्रलादेन संस्था एतानि दशनामानि प्रातृप्ताय पटे शनेश्वरकृता पीडानि कदाचित् भविष्यति कोणस्थपिङ्गळवृक्ष्णो रुद्रान्तको यमः सौरिशनेश्वरो मनः प्रलादेन संस्था एतानि दशनामानि प्रातृप्ताय पटे शनेश्वरकृता पीडानि कदाचित् भविष्यति शनिश्चराय शान्ताय सर्वाभीष्टप्रदायिने शरण्याय वरण्याय सर्वशाय नो नमः 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 ओम भूर्भुवस्सुवः ओम तत्सवितुर्वरेण्यं भर्गो देवस्य धीमहि धियो न प्रचोदयात् ओम भूर्भुवस्सुवः ओम तत्सवितुर्वरेण्यं भर्गो देवस्य धीमहि धियो न प्रचोदयात् ओम भूर्भुवस्सुवः ओम तत्सवितुर्वरेण्यं भर्गो देवस्य धीमहि धियो न प्रचोदयात् ओम भूर्भुवस्सुवः ओम तत्सवितुर्वरेण्यं भर्गो देवस्य धीमहि धियो न प्रचोदयात् ओम भूर्भुवस्सुवः ओम तत्सवितुर्वरेण्यं भर्गो देवस्य धीमहि धियो न प्रचोदयात् ओम भूर्भुवस्सुवः ओम तत्सवितुर्वरेण्यं भर्गो देवस्य धीमहि धियो न प्रचोदयात् ओम भूर्भुवस्सुवः ओम तत्सवितुर्वरेण्यं भर्गो देवस्य धीमहि धियो न प्रचोदयात् ओम भूर्भुवस्सुवः ओम तत्सवितुर्वरेण्यं भर्गो देवस्य धीमहि धियो न प्रचोदयात् ओम भूर्भुवस्सुवः ओम तत्सवितुर्वरेण्यं भर्गो देवस्य धीमहि धियो न प्रचोदयात् ओम भूर्भुवस्सुवः ओम तत्सवितुर्वरेण्यं भर्गो देवस्य धीमहि धियो यो न प्रचोदयात्। ओम शांति शांति शांति।